Hey, it's Alani from the William Factory. I'm back, all set to create and implement growth and scaling strategies for your business. Don't just dream, let's make it happen. Today, we'll learn how to spot new opportunities, build a growth plan with the resources you have, and start scaling up while staying profitable. This is the 7th of 10 weekly training sessions in our business finance series. Now, let's dig in. As for our tables of content today, we'll talk about identifying growth opportunities, developing a growth strategy that aligns with financial limitation, and scaling a business while maintaining financial stability. Now let's get on to identifying growth opportunities. A growth opportunities is areas within the market or operations where potentials for expansion exist. The areas within the market, it mainly refers to opportunities related to external environment in which a business operates, and this includes new customer segments, that's identifying and targeting previously untapped groups of customers. You have new geographic markets that's expanding into different regions or countries. We have emergency trends that's capitalizing on new trends, technologies, or shift in consumer behavior. We have competitive landscape that's identifying weaknesses in competitors or opportunities to differentiate. And changing regulation that's adapting to or leveraging new laws or regulations. The areas within the operations, that's like refer to opportunities for growth and improvement within the external working of a business. And that really includes product, service, and innovation that's developing new or improved offerings that attract more customers or command higher prices. Process optimization that's streamlining external process to increase efficiency, reduce costs, and improve output. We also have technology adaptation that's implementing new technologies to enhance productivity, reach new customers, or create new value propositions. And we have strategic partnership that's collaborating with other organizations to access new markets, technologies, or resources. And we have skill development that's investing in employees, training, and development to enhance capabilities and drive innovation. Potential for expansion exists. That really means this highlight the key of characteristics of a growth opportunity, the possibilities for a positive development, increase in scales, revenues, market shares, or overall business value. Here, let's talk about identifying growth opportunities. This slide usually visually engaging hexagonal puzzles with 5 interconnected pieces, each representing a crucial step in identifying growth opportunities. The interconnectedness emphasizes that these steps are not isolated but rather build upon each other. The first part of identifying growth opportunities, you want to analyze your market. And that's before you begin planning for an expansion, you need to understand the market you're working in. And that this fundamental step, a thorough understanding of the existing market, is crucial before identifying potential growth avenues. And this involves market size and trends that's determining the current size of the market, its historical growth rate, and identifying emerging trends that's technological advancement, changing consumer preference, or demographic shifts. You also want to have customer analysis that's understanding your current customer base, that's needs, behavior, demographics, or psychographics, and identifying potential new customer segments. You want to have competitive analysis that's analyzing your competitors, that's their strength, weakness, market shares, strategies, and this helps identifying underserved areas or opportunities to differentiate. You also want to have industry analysis that's examining the broader industry landscape, including regulatory environment, supply chain demographics or dynamics, and potential disruptions. And last, you want to need to know is market needs and gaps, and that's identifying unmet needs or gaps in the market that your business could potentially address. So, on to the second part, which is access your resources. That a successful expansion requires resources. You need to make sure you have the refunds and personal necessaries to make it happen. And that this step focuses on the internal capabilities and limitations for your business. Growth opportunities require significant investment and human capital. This assessment includes financial resources, which is, do you have sufficient capital to refund the expansion? That's research and development, marketing, infrastructure, hiring. Can you access additional fundings through loans, investors, or other means? Another thing you want to include is human resources, like, do you have the right people with the necessary skills and expertise to execute the growth strategy? Will you need to hire and train new personnel? You also want to have operational capacity, which is, can your current operations handle the increased demand or new activities associated with the growth opportunity? And will you need to invest in new equipment, technology, or infrastructure? And last would be intangible assets. That's, do you have the necessary brand recognition, intellectual property, or customers' relationship to support the expansion? The third part, you want to examine your business model, and that's expanding your business may require a change in your business model as well. And that means your current business model might not be suitable for all growth opportunities. This step involves critically evaluating your existing model and considering potential adaptations or entirely new models. That includes value proposition, meaning does your current value proposition align with the identified growth opportunities? Might it need to be modified or a new one created? You also want to think about is revenue streams. That's, how do you currently generate revenue? Will new opportunities require different or additional revenue streams? You also want to think about is customers' relationship. That's, how do you interact with your customers? Will expanding require different approaches to customers' acquisitions, retentions, or service? You also want to have key activities. That's, what are the core activities your business perform? Will new opportunities necessitate new or modified key activities? You also want to think about is key resources. That's, what are the essential resources you rely on? That's technology, infrastructure, intellectual property. Will expansion require acquiring or developing new resources? You also want to have key partnership. That's, who are your key partners? Will new opportunities benefit from new or different partnerships? And last would be cost structure. That's, what are your major costs? How will expansion impact your cost structure? Will new opportunities require a different cost model? On to the fourth one, we have identified growth opportunities. And it's, once you assess your market, resources, and business model, it's time to focus on potential growth opportunities. Meaning, this is the core step where you actively brainstorm and identify specific avenues for growth, leveraging the insights gained from the previous steps. And this could involve market penetration, that's selling more of your existing products or service to your existing market. You also want to think about is market development, that's selling your existing products or service to new customer segments or geographic markets. Another thing would be products development, that's developing new products or service for your existing market. Diversification, that's another one, which is developing new products or service for new markets. Acquisitions or mergers, that's growing by acquiring or merging with other businesses. And last would be strategic partnership, which is collaborating with other organizations to reach new markets or offer new products or service. On to the last one we have is develop a plan of action. After identifying growth opportunities, you need to create an actionable plan that outlines how will you take advantage of them. Meaning, identifying opportunities is only the first step. A detailed plan is crucial for successful execution, and this plan should include specific goals and objectives. That's, clearly define what you want to achieve with the growth opportunity, like say increase market shares by X percent, enter Y new markets. You also want to have strategic and tactics that's outline the specific actions you will take to achieve your goals. You also want to think about this resource allocation that's detail how financial, human, and other resources will be allocated to the growth initiatives. You also want to think about its timelines and milestones that's set realistic deadlines and track progress against key milestones. Another thing is key performance indicators or KPI for short, that's identify metrics to measure the success of the growth initiatives. You also want to think is risk assessment and mitigation, that's identify potential risks and develop strategy to address them. And last would be contingency planning, that's develop backup plans in case of unexpected challenges. The puzzle pieces design effectively illustrates that these five steps are interconnected and iterative. The insight gains in one step inform the other. For example, market analysis might reveal a promising opportunity, but resources assessment might highlight limitations that require adjusting the business model or the scope of the opportunity. In summary disorder, this slide presents a structured and logical approach to identifying growth opportunities. It emphasizes the importance of a thorough understanding of the market, a critical evaluation of the existing business model and resources, and the development of a concrete action plan to capitalize and identify opportunities. Here we have the slide of using financial statements analysis to identify growth opportunities. And this slide uses three connected circles, each representing a key stage in the analysis. The connection visually emphasizes that these steps are related and build upon each other. The first one we have is identify profitable products or service lines, and that's by examining revenue streams and associated costs. Startups can identify which products or service lines are generating the most profits. And this initial step focuses on understanding the current performance of the startup's offerings by analyzing the income statements, profit or loss statements. Startups can understand the segment revenues, that's break down total revenues by individual products or service lines to see which contribute the most to the top line. Another would be analyze cost of goods sold or cost of service. And it's determine the direct costs associated with producing each product or delivering each service. Another would be calculate gross profit that subtracts COGS from the revenue for each product or service lines to understand its basic profitability. You also want to think about is allocate operation expenses, that's where possible allocate operating expenses like marketing, sales, and administrative costs to specific products or service lines to get a more accurate picture of their net profitability. You also want to identify high margin offerings that pinpoint the products or service that generate the highest profit margins. These are potential areas for further investments and growth. And last would be identify underperforming offerings that recognize products or service with low or negative profit margins. This might lead to decisions about improving efficiencies, repositioning, or even discontinuing them to free up resources for more profitable areas. And how this leads to growth opportunities that's focusing on and investing more in highly profitable products or service lines can drive overall growth, and this could involve increased marketing and sales efforts, products and service enhancement, and scaling operations. The second step we have is spot market trends, that's analyzing revenues, growth rates, and customers' demographics can help identify emerging market trends. And this step involves looking at the trends within a financial data and connecting them to broader market dynamics by analyzing revenue growth rates, and that's examining the year over year or period over period growth in overall revenues, and more importantly, the growth rates of specific products or service lines. High growth rates in certain areas might indicate alignment with emerging market trends. Another would be customer demographics, that's analyzing who is buying which products or service, changing in the demographic makeup of the customer base for specific offerings could signal evolving market preferences or the emergence of new market segments. We have demographic sales data, and that's identifying which regions are experiencing the most significant growth, and this could point to geographic expansion opportunities. And last, we have sales channel performance, that's analyzing which sales channels, that's online, direct sales, retails, and that are driving the most growth. And this can inform decisions about channel optimizations and investments, and how this leads to growth opportunities. Identifying market trends allows startups to capitalize on growing demand, target emerging customer segments, adapt to changing preferences, and identifying untapped markets. And the last step would be assess investment opportunities, and that's by analyzing cash flow patterns and probability. Startups can assess potential investment opportunities such as expanding into new markets or acquiring complementary businesses. And this final step uses the insight gained from the previous analysis along with an examination of the cash flow statements to evaluate potential strategic investment by analyzing cash flow patterns, that's understanding the timing and consistencies of cash inflows and outflows. Strong and positive cash flow indicates the startup has the financial capacity to pursue growth initiatives. Another thing would be overall probability, that's assessing the startup's overall probability and the probability of specific segments. Sustainable probability is crucial for funding future investments. And last would be available cash reserves, that's determining the amount of cash on hand that can be allocated to growth initiatives. And how this leads to growth opportunities, this analysis helps startups evaluate specific investment options such as expanding into the new markets, acquiring complementary businesses, investing in research and development, upgrading infrastructure, and strategic partnership. In summary, this slide highlights a strategic approach for startups to leverage their financial statements to identify and evaluate growth opportunities. By understanding their most profitable areas, recognizing emerging market trends, and assessing their financial capacity, startups can make informed decisions about where to focus their resources for future expansions and success. Here we have the image of outlines four key areas where financial analytics to identify growth opportunities for a business. This slide used a diamond shape divided into four color sections, each representing a distinct areas of financial analytics that can contribute to identifying growth opportunities. The central agreement suggests that these areas are interconnected and contribute to a holistic understanding. So there are four parts of utilizing financial analytics to identify growth opportunities. The first one we have is market analysis. That's financial analytics can provide valuable insights into market trends, customer preferences, and competitive dynamics. This area emphasizes using financial data to understand the broader market environment. And this involves analyzing industry trends, that's examining financial reports and data from overall industry to identify growth sectors, emerging technologies, and potential disruptions. And this also involves looking at revenue growth rates, profitability trends, and investment patterns across the industry. You'll also have understanding customer preferences, that's analyzing sales data by products, region, and customer segments to identify shifts in demand and evolving preferences. Financial analytics can reveal which products or services are gaining tractions and which are declining. You also want to think about is evaluating competitive dynamics, that's studying the financial performance of competitors, that's like revenue growth or profitability, market shares, and to identify their strengths and weakness. And this can highlight potential opportunities to differentiate or exploit gaps in the market. And last, we have price elasticity analysis. That's understanding how changes in price affect demand for different products or service. And this can inform pricing strategies for growth. And how this leads to growth opportunities is by understanding the market landscapes, business can identify new market niche, emerging products or service categories, competitive advantages, and strategic partnership. The second one we have is customer lifetime value or CLV analysis. And that CLV analysis involves calculating the value of a customer over their entire relationship with the organization. CLV is a crucial metric that predicts the total revenue a customer is expected to generate for a business throughout their entire engagement. Analyzing CLV involves calculating CLV, that's using historical transaction data, purchase frequency, average purchase value, and customer retention rates to forecast the long term value of different customers' segments. Another thing it involves is identifying high value customers, that's pinpointing customer segments with the highest CLV. We also have understanding customer retention drivers, that's analyzing factors that contribute to customers' loyalty and longevity. And last would be evaluating customers' acquisition costs, or CAC for short. That's comparing the cost of acquiring customers in different segments with their potential CLV to ensure profitable acquisition strategies. And how this leads to growth opportunities is understand CLV allows business to focus on customers' retentions, target high value customers, optimize customers' acquisition strategies, and personalize customers' experience. On to the third one we have is products and service portfolio analysis. That's analytics can help businesses evaluate the performance of their product and service offerings. This area focuses on analyzing the financial performance of the individual components of a business offering, and this involves analyzing sales and revenues by products or service, that's identifying which offerings are generating the most revenue and which are underperforming. We have analyzing profitability by product or service, that's determining the profit margins for each product or service lines. We got identifying growth product service, that's pinpointing offerings with high growth rates and strong profitability. These are prime candidates for further investment. You also have identifying declining or low profit products or service, that's recognizing offerings that may need to be revitalized, repositioned, or even discontinued to free up resources. And last is performing break even analysis, that's understanding the sales volume required for each product or service to become profitable. How this leads to growth opportunity is by analyzing the product and service portfolio helps business to focus on high growth and high profit offerings. You also have identifying opportunities for innovation, optimize pricing strategies, and streamline the product or service mix. On to the last one we have is market segmentation. That's analytics can be used to segment the market based on various criteria such as demographics, buying behavior, or psychographics. Market segmentation involves dividing a broad target market into smaller, more homogeneous groups of consumers with similar needs, characteristics, or behavior. Financial analytics plays a role in identifying profitable segments, that's analyzing the purchasing power, spending habits, and probability of different customer segments. You also get understanding segment specific needs, that's examining sales data and customers' feedback within each segment to identify unique requirements and preferences. You also got evaluating segment growth potential, that's assessing the size and growth rate of different market segments. And you'll also have analyzing segment responsiveness to market efforts, that's understanding how different segments react to various marketing campaigns and pricing strategies. How this leads to growth opportunities, effective market segmentation allows business to tailor marketing and sales efforts, develop segment specific products and service, optimize pricing strategies for each segment, and identify new and underserved segments. In summary, this slide emphasizes the power of financial analytics in uncovering growth opportunities by providing insights into the market, understanding customers' value, evaluating products or service performance, and segmenting the market effectively. By leveraging these four areas of analysis, business can make more informed strategic decisions to drive sustainable growth. Here, this slide, we have four color segments for using financial insights to identify growth opportunities, each representing a distinct area where financial insight plays a crucial role in identifying growth opportunities. The first one we have is market analysis. That's financial insights can help decision making, analyze market trends, customer behavior, and competitive dynamics. This area emphasizes using financial data to gain a deeper understanding of the external environment in which the business operates, and this involves analyzing market trends, and that's examining industry-wide financial data, that's revenue growth rates, investment patterns, profitability benchmarks, to identify emerging trends, growing sectors, and potential areas of opportunities or decline. You also want to have understanding customer behavior, that's analyze sales data, purchase patterns, customer demographics, and spending habits to identify what customers are buying, how much they are spending, and where they are making purchases. This can reveal unmet needs or evolving preferences. You also want to involve evaluating competitive dynamics, that's studying the financial performance of competitors to identify their strengths, weakness, and potential vulnerabilities that the business can exploit. And you want to involve identifying market gaps, that's analyzing financial data to pinpoint underserved customer segments or product service areas where demand is not being fully met. A strong understanding of the market through financial insights can reveal new target markets, emerging products or service needs, and opportunities to gain competitive advantage. To the second part, we have customers' insights, and that's financial insights can provide valuable information about customer preferences, buying patterns, and profitability. This area focuses especially on understanding the financial aspects of the business relationship with its customers, and it involves analyzing purchase history, that's examining past transactions to identify frequently purchased items, average order values, and customers' loyalty patterns. You also want to know understanding customers' profitability, that's determining which customer segments or individual customers are the most profitable based on their spending and cost of serving them. You also want to identify customers' lifetime value. That's forecasting the total revenue a customer is expected to generate over their entire relationship with the business. High customers' lifetime value segments represent significant growth potential. And you want to have analyzing customers' acquisition cost, and that's understanding the cost of acquiring new customers in different segments and comparing it to the potential profitability. Deep customer insight derived from financial data can help businesses personalize marketing efforts, develop targeted products and service, improve customer retention strategies, and optimizing pricing and promotions. On to the third one we have is products development, and that's financial insights can guide decisions makers in developing new products or improving existing ones. This area highlights how financial data can inform the innovation and evolution of a business offerings, and this involves analyzing sales performance of existing products, that's identifying which products are selling well, which are lagging, and their respective profit margins. Another thing will be involved is understanding customers' feedback and purchase patterns. That's connecting financial data with customers' feedback and buying behaviors to identify areas for products improvement or unmet needs that could inspire new products development. Another would be evaluating the probability potential of new products idea. That's forecasting the potential revenues, costs, and profitability of new product concept based on market research and financial modeling. And you have analyzing the return on investment of products development initiatives, that's assessing the financial viability of investing in the development of new and improved products. Financial insights can guide product development by identifying profitable product extensions, developing new high margin products, and improving existing products to increase sales and customer satisfaction. On to the last one we have is geographic expansion. That's financial insights can help decision makers assess the financial viability of expanding into new geographic markets. This area focuses on financial data to evaluate the potential of entering new regions or countries, and this involves analyzing market size and growth potential in new regions. That's researching the financial characteristics of potential new markets, including their size, growth rates, and economic stability. Another thing will be involved with evaluating competitive landscape in new markets that study the financial performance and market shares of existing players in these regions. We have forecasting potential revenues and costs in new markets that estimate the potential sales, operating expenses, and investments required for expansions. We have assessing the return on investment of geographic expansion, that's determining the financial feasibility and potential probability of entering new geographic areas. And we have understanding local customer behavior and pricing sensitivities. That's analyzing financial data related to consumer spending and price elasticity in potential new markets. Financial insights are critical for making informed decisions about geographic expansion by identifying financially attractive new markets, developing market entry strategies, and allocating resources effectively. In summary, this slide illustrates a holistic approach to identifying growth opportunities by leveraging financial insights across four key areas: understanding the broader markets, gaining deep knowledge of customers, strategically developing products, and making informed decisions about geographic expansions. By analyzing financial data in these interconnected ways, businesses can make more strategic and financially sound choices to drive sustainable growth. Here we have is small business can find opportunities in finance, and this indicates the content will focus on potential business ventures for a small enterprise with financial sector itself rather than just how small business can use finance. There are a few things about it. The first one we have is digital banking and payments, and that's increasing shift towards online transactions and digital payments. And this point identifies the significant and ongoing trend of individuals and businesses moving away from traditional brick and mortar banking and cash transactions towards online and digital methods. This shift creates various opportunities for small business to cater to this evolving landscape, including developing niche digital banking solutions, creating innovative payment processing solutions, building mobile payments applications, offering digital financial literacy and education, and developing secure digital identity and authentication solutions. Small businesses can be more agile and innovative than large financial institutions, allowing them to quickly adapt to emerging digital trends and cater to niche trends needs within the digital banking and payments ecosystem. They can focus on user experience, security, and specific industry requirements to carve out a competitive advantage. We have is alternating lending, and that's alternating lending platforms such as peer-to-peer lending or crowdfunding provide opportunities for business to access capital. And at this point highlights the growth of financial platforms that operates outside the traditional banking system to connect borrowers and lenders directly or facilitate fundraising through collective contribution. This creates opportunities for small businesses in several ways. That is, creating and managing niche peer to peer lending platforms, developing crowdfunding platforms for a specific purpose, providing due diligence and risk assessment service to alternate lending, developing tools and technologies for alternative lending platforms, and offering consulting service to business seeking alternative funding. And small businesses can leverage their understanding of specific communities or industries to build specialized alternative lending platforms or provide crucial supporting service. Their agility can allow them to adapt to the evolving regulatory environment and technological advancement in the sector. We have is financial management tools, that's developing or offering financial management softwares, apps, or consultancy service can help businesses streamline their financial operations. This point focuses on ongoing needs for businesses of all sizes, especially small business, to manage their finances effectively. This creates opportunity for small business to provide tools and expertise in this area. And that is developing user-friendly financial management softwares and apps, providing specialized financial consulting service, creating industry-specific financial management solutions, offering training and support for financial management tools, and developing integrated financial dashboards and reporting tools. Small businesses can leverage their understanding of the challenges faced by other small businesses to develop practical and affordable financial management solutions. They can build strong relationships with their clients and offer personalized support that larger software companies or consulting firms may not provide. To continue on, we have financial education and consulting. That's attending financial education workshops like the one you're watching right now. You have webinars or consulting service can be valuable opportunities to learn of best financing practices. This point emphasizes the importance of continuous learning and seeking expert advice in the realms of finance. It highlights several avenues for acquiring this knowledge: financial education workshops, webinars, consulting service, learning best financing practice. And this opportunity for individuals, small business, you can improve financial literacy, better decision making, access in expert advice, networking, and stay updated. Now, the last one we have is e-commerce finance solutions, and that's as e-commerce continues growth, there's a demand for finance solutions tailored for online businesses such as payment gateways, inventory financing, or working capital loans. This point highlights the burgeoning e-commerce sectors and specific financial needs of online businesses. This continued growth of online sales creates a demand for specialized financial products and service. And that includes payment gateways, inventory financing, working capital loans, cross-border payment solutions, fraud detection and prevention service, revenue-based financing for e-commerce, and e-commerce accounting and tax solutions. As for opportunity for business, including the small business, you will develop niche e-commerce financing solutions, creating integrations with e-commerce platforms, offering competitive practice pricing and features, and providing
When it
specialized
comes to
expertise.
strategies, you want to do some market research. And that's process of gathering, analyzing, and interpreting information about the market, including its consumers and competitors. And the importance of market research will be understanding customer needs, market trends, and competition. Here we have this image is a visual representation of an Ansoff matrix, and that's a strategic planning tool that provides a framework to help businesses analyze and plan for growth. It maps out four potential growth strategies based on whether a business is targeting existing or new markets with its existing or new products. The axis for the horizontal axis, and that's products, this axis distinguishes between a company's existing products and new products that it might develop. For the vertical axis, which is markets, this axis differentiates between existing markets that the company currently serves and new markets that it could potentially enter. So let's talk about the four growth strategies. Let's talk about the market penetration, and that is the existing products in existing markets. This strategy focuses on increasing sales of a company's current products within its current markets. It aims to grow market shares without significantly altering the products or targeting new customers group. And how you achieve it is increasing usage rates among existing customers, attracting competitors' customers, attracting non-users of the products category, or improving marketing and promotions, lower prices, and improving distribution channels. Generally considered the lowest risk growth strategy as the company is operating in familiar markets with familiar products. Onto the market development, that's existing products in new markets. And this strategy involves taking the company's current products and trying to sell them in new markets. This could involve new geographic regions, new customer segments, or new distribution channels. And how you achieve it is geographic expansions, new customer segments, and new distribution channels. And this considered a medium risk. While the product is familiar, the company is entering unknown territory with potentially different customer needs, competitive landscapes, and regulatory environments. For the product development, that's new products in existing markets, and this strategy involves developing and introducing new products or improved versions of existing products to the company's current customer base. The goal is to leverage the company's understanding of its existing market and customers needed to drive growth. And how you really achieve it is developing new features or functionalities of existing products, creating entirely new product lines, improving product quality or performance, and offering different variations or sizes of existing products. And this is considered a medium risk. The company understands its market, but developing and launching new products can be challenging and involve significant investment and the risk of product failure. And the last one we have is diversification, and that's new products in new markets. And this is the most ambitious and potentially the riskiest growth strategy and involves entering completely new markets with completely new products. And to achieve it is related diversification and unrelated diversifications. And as for the risk level, it's considered the highest risk growth strategy as the company is venturing into unfamiliar territory onto fronts, new products, and new markets. It requires significant resources, market research, and a strong understanding of both of the product and the new market. This summary and overall, this provides a valuable framework for business to think strategically about their growth options by considering the interplay between their products and the market they serve. It helps businesses assess the potential risks and rewards associated with different growth strategies and make informed decisions about their future decisions. Here we have the SWOT analysis. A SWOT is a strategic planning tool used to evaluate the strength, weakness, opportunities, and threats involved in a project or in business venture. It helps organizations identify internal and external factors that are favorable and unfavorable to achieve their objectives. The SWOT analysis is typically presented as a 2 by 2 matrix, with each quadrant representing one of the four elements. The first one you have is strength, and this focuses on the internal positive attributes of the organization or projects. These are the things that the organization does well and it gives it an advantage over others. Key questions to consider: what makes your service the top tool for addressing consumer needs? What are your cut edging features, your novel capabilities that set your company apart? For the weaknesses, it focuses on the internal negative attributes of the organization or project. These are the areas where the organization is lacking or where is it at a disadvantage compared to others. Key questions to consider: what aspect of your company has room for growth? What part of your business could be improved to strengthen your service? And what element has prompted feedback? For the opportunities, it focuses on the external positive factor that the organization can leverage to its advantage. These are trends, events, or situations in the external environment that could lead to growth or success. Key questions to consider: what are consumer cravings? What does your community need? And what skills, knowledge, and tools does your company have to extend to individuals, businesses, or organizations? And the last we have is threats, and this focuses on the external negative factors that could potentially harm the organization or project. These are trends, events, or situations in the external environment that could pose challenges or risks. Key questions to consider: what obstacles do you foresee challenging your company's success? Which competitors have the potential to threaten your business? And is your consumer market evolving in a way that poses a risk to your company's future? The SWOT analysis is a powerful tool for strategic thinking by systematically evaluating external strengths and weaknesses alongside external opportunities and threats. Organization can gain a clearer understanding of their current position and more informed decision about their future directions. Since this is a finance series, we gotta talk about the finance SWOT analysis for examples. For the strengths, these are financial aspects that are working well and provide an advantage. Key question to consider: what positively affects your finance? What moves you closer to your goals? List your competitive advantages, feature exclusive to your market, and what do you offer that is lucrative? For the weaknesses, these are financial areas that need improvement or put the business at a disadvantage. Key question to consider: list internal financial elements, debt, lack of income, cash deficiencies, low credit ratings, obsolete receivable invoices, COVID related economic situations. For the financial opportunities, these are the opportunities in the financial element that can be exploited. Key question to consider: attainable actions that you will take, income, investment, debt reductions, possible discounts from suppliers, equipment investment, and positive industry trends. For the threats, and that these are financial environments that need to be addressed or mitigated. Key questions to consider: external forces not in your control, what your competitors do better, poor selection of products, competitor has lower prices, and new laws activating. Based on the analysis, develop specific financial strategies and actions plans to leverage financial strength, address financial weaknesses, capitalize on financial opportunities, and mitigate financial threats. By conducting a thorough financial SWOT analysis, businesses can gain a clearer understanding of their financial health and the external financial landscape, enabling them to make more informed decisions about develop robust financial strategies for the future. Here we have the present value of growth opportunities, or PVGO for short. That's financial metrics that represents the value of a company's future growth opportunities discounted to present value. It is calculated as a difference between the market value of the company and the no growth value of its equity. In the bottom, you see the formula of PVGO, which is stock price minus the earnings, and that's divided by the cost of equity. Probably the most important indicator for a lender to make a business loan is consideration of a company's debt service coverage ratio. This is an examination of the free cash flow, which are business funds not otherwise obligated to specific purpose and available for loan payments. This ratio is determined by taking your expected net cash flow for the entire business, usually on an annual basis, and dividing it by expected loan payments, which is combination of both interest plus principal payments for the same annual time period. Lenders want assurance that a business will have more funds available to make loan payments than just breaking even after loan payments are made. So, in this case, the lender wants to know that you have what is called a going business, which is making money after business operational costs are expended. The debt service coverage ratio is a known as an underwriting criteria that lenders use to assess the viability of a loan repayment. Now let's look at a small business that consider applying for a business loan. In this example, say a company expects to earn $15,000 in annual net income after using a loan to expand business revenues, say by purchasing new equipment, making facility improvements, or obtaining a delivery vehicle. In this case, loan payments are $1,000 per month, which is $12,000 per year. So dividing the $15,000 of free cash flow by $12,000 in annual loan payments gives a 1.25 debt service coverage ratio. This is usually the minimum a bank or credit union lenders will want to be assured of in order to approve the loan. It demonstrates that the business will have 25% more funds available after loan payments are made. This reduces the risk of the lender since it is likely the business can make all required loan payments while continuing to earn profits as an enterprise. Note that there may be some government and nonprofit programs that will lend at ratios of less than 1.25 in a debt service coverage ratio. These programs are usually subsidized by the government or philanthropic sources to grow enterprise that have lower profit margins but need to access to affordable finance to maintain and hopefully to grow the business. On the other hand, there are banks, credit unions, and even community development financial institutions called CDFI that require more than 1.25 in debt service coverage ratios. These lenders can be even more conservative in avoiding risk of non payments of loans and may even require a ratio of 1.5 or higher, meaning you have 50% more funds available than the amount needed to make loan payments. These more conservative lenders may be concerned about the ability of the business to make the projected coverage ratio based upon the background of the firm. However, there are federal lending rules that prohibit certain forms of discriminatory practices, such as requiring higher lending standards based upon the race, ethnicity, or geographic location of a business. Now, we will look at the debt capacity tool that enables a company owners to consider whether an existing profitable business can earn more profits from investment using loan funds. Note that the goal should be increasing the company's earnings, not just breaking even after loan payments. Now, on to developing a growth strategy that aligns with financing limitation. So, what it does is to create a plan for business expansions that consider the financial constraints and resources available to the company. So, here we have the steps to develop a strategy. The first one we have is assess current financial situations. That's begin by thoroughly reviewing your company's current financial status, understand your cash flow, revenue streams, expenses, and available capital. And that's which we talk about those topics from the previous videos. So next one, you have set realistic goals. That's establish achievable growth objectives that are in line with your financial capabilities. These goals should be specific, measurable, attainable, relevant, and time bound, or short for SMART. You want to prioritize investment. That's identify key areas where investments is most crucial for growth. Focus on initiatives that promise the highest return on investments and aligned with your strategic objectives. You also have optimized operational efficiencies. That's look for opportunities to improve operational efficiencies and reduce costs. This could involve streamlining processes, renegotiating contracts, or adapting technologies to automate tasks. And then we have explore financing options. That's research various financing options that can support your growth strategy without straining your cash flow. This could include bank loans, lines of credit, venture capital, crowdfunding, or strategic partnerships. You also want to have monitor and adjust. That's continuously monitor your progress towards your growth goals and financial targets. Be prepared to adjust your strategy as needed based on performance, market conditions, and available resources. Onto the risk management, that's identify potential risks and develop continuously plans to mitigate them. This could involve setting aside a reserve fund for unexpected expenses or developing alternative strategies for achieving your goals. And then we have communication and transparency that keeps stakeholders informed about your growth strategy, financial plans, and progress. Transparency can help build trust and support from investors, employee, and other key stakeholders. On to scaling a business while maintaining financial stability. To talk about what is scaling business, it is an increasing business operation to handle higher demands without proportional increase in costs. And this refers to the ability of a business to serve a significantly larger customer base, process more orders, or deliver more services as demand grows. And this often involves expanding products capacity, improving efficiencies, and optimizing processes. And this is a key differentiator between scaling and simple growth. In scaling, the goal is to achieve economics of scales, meaning that as the business expands, the cost per unit decreases or doesn't increase at the same rate as the output or revenues. Here in this image, we have five key considerations of business scaling. Each point highlights a crucial aspect to focus on when aiming to sustainable growth without a proportional increase in cost. So let's break this down. So here, the first one we got is start with a clear understanding of your target market. And that's before attempting to scale, it's fundamental to have a deep and accurate understanding of the customers you are trying to reach and serve. And this involves identifying your ideal customer profile, understanding market size and potential, validating your product's market fit, and analyzing market trends. A clear understanding of your target market allows you to focus your scaling effects effectively. You can tailor your marketing, sales, and product development to resonate with the right audience, maximizing your resources and increasing the likelihood of successful expansions. Scaling a business based on a flawed understanding of the market is likely to lead to wasted resources and limited success. The second one we have is focus on recurring revenue, and that is a predictable and expected to continue in the future. This often comes from subscriptions, base models, long term contracts, or repeated purchases due to strong customer loyalty. Businesses with a strong base of recurring revenues are often more attractive to investors and can scale more sustainability. Recurring revenue provides predictable cash flow, higher customer lifetime value, increased stability, and potential of organic growth. Implementing subscription models, offering loyalty programs, building strong customer relationships that encourage repeat businesses, and providing ongoing value. On to the third one we have is leverage technology, and this technology plays a vital role in enabling businesses to scale effectively without a proportional increase in cost. This involves adapting and utilizing tools and systems that automate processes, improve productivity, and enhance reach. Leverage technology allows to automate repetitive tasks, reach a wider audience, improve communication and collaboration, analyze data for better decision making, and enhance customers' experience. Implementing CRM system using marketing automation tools, adapting cloud-based infrastructure, utilizing data analytics platform, and offering online sales and support channels. Onto the fourth one we have is build a strong team. That's as a business scales, the demand is on its workforce increase significantly. Having a capable, motivated, and well-structured team is essential for managing growth effectively. A strong team provides expertise and skills, scalable leadership, strong company culture, efficient execution, and adaptability. Investing in recruitment and training, fostering a positive work environment, empowering employees, establish clear roles and responsibilities, and developing scale organizational structures. And the last one we have is stay flexible and adaptable. And the scaling journey is rarely linear and often involves unexpected challenges and changes in the market. The ability to be flexible and adapt to these changes is crucial for long term success. Flexibility and adaptability allows you to respond to market shifts, overcome unforeseen obstacles, embrace innovation, learn from mistakes, and maintain resilience. Fostering a culture of experimentation and learning, regularly monitoring key metrics and market feedbacks, being willing to adjust your business models or strategies, and maintaining open communication with the team. To talk about strategies to maintain financial stabilities, you want to have strategic planning that's develop a clear and realistic growth strategy that outlines your goals, target market, and competitive advantages. You also want to think about is financial management that's implement robust financial management practices, including budgeting, forecasting, and regular financial analysis. And we have is cost control that's keep a close eye on expenses that look for opportunities to reduce costs without compromising on quality or customer satisfaction. This may involve negotiating better deals with suppliers, optimizing operational efficiencies, or streamlining processes. You also want to have customers retention that's focused on providing exceptional customer experience to build loyalty and encourage repeat business. And now we have capital allocation that's invest capital wisely in growth opportunities that offer the highest potential returns. Consider alternative financing options such as loans, equity financing, or crowdfunding to fund expansion plans without straining cash flow. And lastly is risk management that's identify and assess potential risks that could impact your business, such as economic downturns, regulatory changes, or supply chain disruptions.
So that's it for this training session. Thank you for watching, and please subscribe to us here on William Factory for more videos on how to launch and grow your business. You can also find us on LinkedIn, Facebook, and Instagram. Start building growth and scaling strategies for your business today. This series is made possible with a grant from Washington State Micro Enterprise Association. Bye.